Hi, everyone, this is the Encyclopedia Channel. The book that this program interprets for you is Business Cycles, History, Theory, and Investment Reality. The author, Russ Tweed, is a well-known trend investor. His books Financial Psychology, Innovative Society, and 50 Years of Trend Investing have been translated into multiple languages. It enjoys a high reputation among practitioners. And this book is an economics book for the general public. It can be regarded as a must-read classic for readers who want to understand the economic cycle and everyone who is closely related to the economic cycle. So, how is the business cycle discovered? What are the stages? Why does real estate play a major role in the impact of the economic cycle? How should we respond to economic cycles? After listening to this episode, you will understand. The initial impetus for people to study the economic cycle mainly comes from the fear and escape mentality in the face of economic crisis. In the 18th century, major economies in Europe and the United States were in the early stages of capital markets, and the market economy developed rapidly, accompanied by occasional economic crises, but after each crisis, the economy would usher in a new wave of development. Such cyclical fluctuations have attracted many economists to invest in research. However, with the deepening of research, people found that even if there is no external shock, the cyclical fluctuations of the economy seem to continue to circulate spontaneously, and the reciprocating rotation of prosperity, recession, depression, and recovery seems to be inevitable for market economy countries. A kind of destiny. Scholars' exploration of the economic cycle has gradually shifted from escape to symbiosis. They hope to seek advantages and avoid disadvantages by understanding the logic of cycle operation. And this book comprehensively and objectively summarizes people's main theoretical achievements about economic cycles in the past 300 years. It includes a description and review of the development of economic cycle theory, a summary of the main driving forces and coping strategies of the economic cycle, and a review of the price performance of various types of assets in different types of economic cycles. In the interpretation of this issue, we mainly look at a few questions. First, what is an economic cycle? How was it discovered? Let's go further and talk about what is the driving force of the economic cycle. Finally, let's discuss how we should deal with the economic cycle. First part. What is a business cycle? According to the author's research, the word cycle appeared in the West for the first time in 1662. At that time, the British economist William Petty used the word cycle in his book Taxation. The term refers to the British agricultural cycle, but it is not the economic cycle mentioned in the title of this book. A definition of the business cycle that the author of this book agrees with comes from the American economist Wesley Mitchell. In his book Business Cycle, published in 1913, Mitchell gave a brief description of the popular business cycle theory at that time, and gave a definition, saying that the business cycle is a period of time in the overall economic activities of a country. Fluctuations. In an economic cycle, there will be 4 different stages of expansion, recession, contraction, and recovery in sequence, and a complete cycle will take from 1 to 12 years. Round and round, the periodic rotation of the economy is formed. The author reminds us to pay attention to 2 points. First, the duration of each economic cycle is not fixed. Second, when it happens, what you see is the shock of overall economic activity. As we said earlier, the cycle mentioned by William Petty in the 17th century refers to the cycle of agricultural harvest and poor harvest. Although it can also reflect shock, it is not the overall shock of the economy, so it cannot be called the economic cycle is over. So, when did this shock in overall economic activity begin? According to records, in the 18th century, there were many large-scale economic crises in the Netherlands and the United Kingdom, and after each crisis, the economy would recover, and then usher in another stage of rapid development. In the 19th century, Germany and the United States also began to emerge. Similar situation. Here, let's take a look at the Netherlands and Britain in the 18th century, Germany and the United States in the 19th century. You can definitely find one thing in common. They were all economies with the most developed market economies in the world at that time. According to the conclusion of the author of this book, the emergence of economic cycles requires a relatively mature market mechanism and a credit currency system as environmental support. The specific manifestation in a country is usually that industrial and commercial enterprises occupy the majority of the economy, and in economic activities, the main tool for transactions and pricing is banknotes backed by national credit. Because only when these conditions are met, a country's economy will become a whole. That if one small thing affects the whole body, there will be the general shock situation we emphasized earlier. Earlier we said, what is the economic cycle? In a nutshell, it is an overall and cyclical economic fluctuation that occurs in market economy countries. From today's point of view, this is a very simple sentence. But in fact, more than 100 years have passed since the phenomenon of economic cycle appeared and it was proposed as a specialized concept. Why is this so? We can use a metaphor in the book to understand this problem. The author mentions that we can think of the global economy as a machine in motion. It is huge, with various pistons and gears inside, and it makes a rumbling sound when it runs. From this perspective, we who are in the global economic system actually live in this machine. In the 18th and 19th centuries, people didn't know much about how machines worked, but they could feel that every now and then, the machine would give a huge jolt and mess up their lives. Then what should we do? There must be a way to avoid this shock. This is what people at that time thought when facing the economic crisis. How can we make it not happen? Or, how can I escape it? At the beginning, scholars tended to believe that economic prosperity and crisis were caused by some external shocks or policy mistakes. Then, according to this line of thinking, as long as we find out the specific factors that lead to the economic crisis and then prescribe the right medicine, we can solve the problem. Early researchers did identify a variety of factors, such as monetary factors such as money supply, interest rates, and velocity of circulation, real factors such as investment, savings, consumption, and production, and superhuman factors such as public confidence, irrationality, and panic. Realistic factors. However, the theories formed around these factors are relatively fragmented and unsystematic. The author pointed out that the reason behind this is that these scholars have not yet realized that the occurrence of economic crises is cyclical. Even if no triggering factors appear, this cyclical phenomenon will occur. Later, a French economist named Clement Huglar. He published a book in 1862 called On the Economic Crisis and Development Cycle of Germany, Britain, and the United States. In this book, Huglar demonstrates for the first time through statistical analysis of past economic data that the recurrent economic crises that have occurred in these countries in the past are not simple independent events, but are inherent in the economic organization. Unstable, periodically recurring manifestations. It is the periodicity he proposed that points out the dynamic changes behind the economic instability. It also makes this book revolutionary in the history of economics. Because, from this moment on, our world has truly discovered the economic cycle. In the words of the famous economist Schumpeter, Jugra discovered the New World, but before that, people only discovered some islands near the mainland. The author also explained the word discovery in the book. He said that there is a common situation in the scientific community, that is, when some important phenomenon occurs, many scholars may describe it and discuss it, but this is not a discovery. A phenomenon is truly discovered when its significance is recognized. Therefore, before Jugra discovered this point of view, economists usually said that they were studying economic crises. After that, their research objects really became business cycles. In addition to proposing the concept of cyclicality, Jugra further divided the economic cycle into different stages such as rise, explosion, and liquidation through data research, and pointed out that the average length of an economic cycle is 9 to 10 years. But later, some scholars put forward different views. Generally speaking, there are currently 3 mainstream views on the duration of the economic cycle in the academic circles. The first is the short cycle, 4 to 5 years. The second is the medium cycle, which is 9 to 10 years proposed by Jugra. The third is the long cycle, 18 to 20 years. The reason for this difference is that economists choose different indicators when tracking the economic cycle. It is worth noting that the longer the cycle, the more ambiguous and incomprehensible details in the economic data. Thus, in general, the accuracy of the forecast for the cycle is inversely proportional to the length of the cycle. In other words, the longer the cycle, the harder it is to predict. The second part. What we just said is what is the business cycle and how it is discovered. Next, let's talk about what is the driving force behind the economic cycle. We mentioned that in the face of repeated economic crises, at first scholars thought that each crisis was caused by a specific shock or mistake and could be avoided and escaped. But Huglar's research results made people realize the occurrence of crises is cyclical. The cycle of prosperity, recession, depression, and recovery is like a fate that the market economy cannot escape. Jugra's impact on the mainstream views at that time did not end here. In the book he published in 1862, he also threw out such a sentence: "The only cause of depression is prosperity." The depression mentioned here is the economic crisis we have been talking about. Huglar believes that the arrival of depression, in fact, it shows that the economy is on a normal operating track, and the absence of depression means that something has gone wrong. It can be seen that Jugra's point of view is basically the opposite of the mainstream point of view at that time. And these two opposite arguments actually reflect a question that economists have been arguing for hundreds of years: is the phenomenon of economic cycle endogenous or exogenous? From the end of the 19th century to the beginning of the 20th century, the theory emphasizing the endogeneity of the economic cycle, represented by Jugra and other scholars, became the mainstream in the academic circle. The main point of view of this school is, even if there is no exogenous shock, the cyclical fluctuations of the economy can still circulate endogenously. The prosperous years paved the way for depression, and the depressed season quietly breeds prosperity. After entering the second half of the 20th century, emerging business cycle theories put more emphasis on the role of exogenous shocks, such as monetary shocks emphasized by monetarism, productivity shocks and government procurement shocks emphasized by real business cycle theory, and so on. They believe that these exogenous shocks will be transmitted to various parts of the economy through various mechanisms, thereby bringing about overall economic fluctuations. Looking back at the discussions of scholars on the formation mechanism of the economic cycle, we will find that although the issues are complex and there are many viewpoints, everyone agrees that a certain system that enables the continuous operation of the economic cycle must exist, but this puzzle we haven't unraveled yet. The author extracts 5 main factors that cause the economic cycle from the current numerous research results, namely interest payments, asset prices, real estate construction, capital expenditures, and inventories. Among them, the interest payment is called the monetary factor, and the other 4 are collectively called the economic factor. The specific transmission mechanism of each factor here, let's understand as a whole, their driving effect on the economic cycle. Let's go back to the metaphor the author constructed for us, and regard the global economy as a running machine. Then, these 5 factors are like 5 huge pistons that drive the machine to run. They move up and down at different speeds. The huge impact force caused a big shock inside the economic machine. At this time, the economic crisis occurred. Afterwards, the 5 pistons will move again, leading us into a new cycle. Of all the drivers of the business cycle mentioned in this book, the author emphasizes the role of real estate in particular. He even called the real estate market the mother of cycles. Later, this statement was widely cited in academia and industry. In fact, we all feel that the real estate market has a great impact on the economy. Many of the biggest economic crises in global history are related to real estate. For example, the Great Depression of the U.S. economy in 1929 had a lot to do with the bursting of the real estate bubble and the subsequent banking crisis. In 1991, after the Japanese real estate crash, it fell into 2 lost decades. In 1998, after the bursting of the real estate bubble in Southeast Asia, most economies in 2008, the subprime mortgage crisis triggered by the U.S. real estate bubble eventually evolved into a global financial crisis. But why does real estate have such a big impact on the economy? The author of this book uses real data and a few simple calculations to let us see the logic behind this more intuitively. The author selected a year of moderate economic performance, 2004, as a data sample. In this year, the total amount of global variable price assets is 4 to 5 times the global GDP. The variable price assets mentioned here, as the name suggests, are assets whose prices are not fixed and will change, such as stocks, bonds, real estate, and so on. Real estate accounted for about half of global variable price assets in 2004. In other words, in 2004, the total global real estate price was about twice as much as GDP. So, what about on the other side of the globe, in China? In 2020, the ratio of China's housing market value to GDP is 414%, which is about 4 times. We all know that changes in asset prices will affect the wealth in our hands, and the increase or decrease of wealth will affect our expenditure. Studies have shown that the proportion of this effect is generally 4%. It seems that this number does not seem to be large. But let's imagine, if when the economy is booming, housing prices change from 4 times of GDP to 5 times, and then turn around and fall by January 5th, which is 100% of GDP, this kind of wealth loss is multiplied by 4%, then, if calculated by the expenditure method, the actual growth of GDP in that year will lose 100% times 4% equals 4%. In other words, if the original GDP growth rate could reach 6%, then under the influence of real estate price fluctuations, the actual growth rate may only be 2%. Of course, this is just a very simplified calculation. The actual situation is much more complicated. But the purpose of the author's calculation is to let us see that because the price base of the real estate market is very large, and it is closely related to people's actual wealth, the price fluctuations in the real estate market will only affect the overall economy. Conditions have such a big impact. Not only that, the real estate market also has multiple amplification effects. For example, real estate prices will have an impact on real estate development and construction, and real estate construction is also an important part of GDP. Therefore, the actual impact of the real estate market on the economy may be greater than what we just calculated. In the book, the author also uses a research paper from the International Monetary Fund to show us that the consequences of falling real estate prices are much more serious than the stock market depression. In 1933, American Homer Hoyt conducted research on real estate transaction data in Chicago over the past 103 years, as well as all related commercial, political, and demographic events around him, and came to an important conclusion: real estate exists for 18 to 20 years cycle, which is a slow one with huge swings. In the 103 years he studied, every housing crisis was synchronized with the deterioration of the overall economy. The cycle that Hoyt discovered is one of the 3 main types of economic cycles we mentioned earlier, commonly known as the long cycle or real estate cycle. Based on the content just mentioned, when we observe the real estate cycle, we can partially refer to several economic indicators mentioned in the book. The first indicator is the ratio of total variable price assets to GDP. If this number is rising, it means that the economy is on the way to prosperity; otherwise, it means that the economy has a tendency to decline. The second indicator is the number of new houses. The author here gives a specific method to predict the economic depression. If the current housing price has risen by 40% to 55% compared with the previous lowest point, and at the same time, the growth of the number of new houses under construction slows down, even negative growth has begun, which means that this round of real estate boom is coming to an end. Some scholars also mentioned a simpler indicator for judging the real estate cycle. He said, if you buy a house, you feel that it is getting more and more difficult to apply for a loan, the down payment requirements are getting higher and higher, and the mortgage interest rate keeps rising, and the house price will basically come to an end. If you think it makes sense, you can also make a reference. Now let's review the key points of this book. The business cycle refers to the overall and cyclical economic fluctuations in the market economy countries. The initial impetus for people to study the economic cycle mainly comes from the fear and escape mentality in the face of economic crisis. In the face of repeated economic crises, at first scholars thought that each crisis was caused by specific shocks or mistakes and could be avoided and escaped, but Jukra's research results made people realize that the crisis occurrence is cyclical. The cycle of prosperity, recession, depression, and recovery seems to be a kind of fate that the market economy cannot escape. Scholars' exploration of the economic cycle has gradually shifted from escape to symbiosis. At present, there are 3 mainstream views in the academic circle on the duration of the economic cycle, namely the short cycle of 4 to 5 years, the medium cycle of 9 to 10 years, and the long cycle of 18 to 20 years. Among them, the long cycle is also known as the real estate cycle. The author of this book refers to the real estate market as the mother of cycles. The reason is that the real estate market not only has a large price base and is closely related to people's actual wealth, but also has multiple amplification effects. Therefore, price fluctuations in the real estate market will have a huge impact on the overall state of the economy. Finally, let's use the title of this book to discuss a question. If the economic cycle is doomed to be unavoidable, how should we deal with it? For the country, the headache must be the depression stage in the economic cycle. Early economists generally assumed that during a depression period, even without intervention, the economy would return to the path of growth on its own. Some scholars further suggested that human intervention would have a counterproductive effect on economic recovery. There are also many scholars who stand on the opposite side and believe that the government should intervene through fiscal stimulus, monetary stimulus, and other policies to bring the economy out of the trough. Over the past many years, the pendulum of Western economics has swung back and forth between intervention and laissez-faire, and scholars from both schools have been arguing endlessly. However, the author also reminds us that whether it is the faction that advocates intervention or the faction that advocates laissez-faire, they are all defenders of the market economy, and they all admit that the fundamental force to get the economy back on track comes from the self-operation and repair of the market. Therefore, all these discussions are based on the specific premise of market economy. From a longer-term perspective, the economic cycle is just a phenomenon that our economic society has developed to a certain stage in more than 300 years. Of course, in our foreseeable future, we will continue to live in an economic system where market mechanisms dominate the allocation of resources, which means that each of us will have to accompany the economic cycle for a long time. For individuals, the significance of understanding the economic cycle may be to help us look at the ups and downs of the economy from a more calm and rational perspective. Understand that prosperity does not last forever, and recession is not the opposite of prosperity. The two are an inseparable whole that goes hand in hand. From the perspective of investment, if you understand the existence of the economic cycle, you will not expect the bull market to last forever, and you will not have to worry about the market's depression from now on. You will understand that the most valuable thing in investment is the wisdom to plan for a rainy day when it is booming. There is also the courage to persevere patiently in times of recession. Looking back on the more than 300 years since the birth of the economic cycle phenomenon, we can also find one interesting thing. That is, human beings are always forgetful. During periods of stability and prosperity, people tend to forget about the business cycle and even question its existence. However, during times of recession and depression, people pay more attention to the business cycle. Therefore, human beings' research on the economic cycle itself has periodicity. But in any case, what we need to remember is that in the economic machine we are currently in, the force of the cycle will always exist, and its internal operation logic, even the brightest minds in the world still have no idea. Impossible to penetrate. Therefore, in the face of such a force, perhaps the wisest choice is to always remain humble and prudent. Because, throughout history, whenever people think they have overcome the economic cycle, it is often the time when the punishment of cycle power is about to come. This is the end of this episode of the show. What do you think about it differently? Welcome to leave a message to discuss with everyone. Hey, if you like our channel, please subscribe us. Haha, remember to like it.